Brad Williams, Frugal Finance. 12.1, the planning period. Shorten the portfolio duration. Think about $100 million bond investment of bond C with a duration of 9.285 years. Assume that a manager wants to shorten the portfolio duration to 6 years to match a given planning period. The shortening could be accomplished by selling bond C and buying bond A until the following conditions are met. WA D of A plus WC D equals 6 years WA, where WI is the percentage of the portfolio funds committed to asset I. This means that the manager must put 56.39% of the $100 million in bond A, the funds coming from the sale of bond C. Call this portfolio 1. Alternatively, the manager could adjust the portfolio's duration to match the 6-year planning period by trading interest rate futures. In bond portfolio 2, the manager will keep $100 million in bond C and trade futures to adjust the duration of the combined portfolio of bond C and futures. If bond C and T-bill futures comprise bond portfolio 2, the T-bill futures position must satisfy the following condition. P of P is equal P of C N of C plus F of P and T, where P of P is the value of the portfolio, P of C is the price of bond C, F of P T-bill is the T-bill futures price, N of C is the number of C bonds, and N of T is the number of T-bills. So the following equation expresses change in the price of a bond as a function of duration and the yield on the assets. Equation 6.1, D of P is equal negative cap D, 1 plus R, divide this 1 plus R of P. Applying equation 611 to the portfolio value, bond C and the T-bill futures, we have the following immunization conditions. We have this very extended equation. D of P, I'm not going to go over this entire thing. This can be simplified in the following. D of P, P of P is equal D of C, P of C, N of C plus D of T-bill, F of P T-bill, N of T-bill, because immunization requires mimicking bond portfolio 1, which has a total value of $100 million or duration of 6 years. It must be the case that P of P is equal to 100 million, D of P is equal to 6. D of C equals 9.2853, P of C equals 449.41, N of C is equal to 222.514, D of T equals 0.25, and F of P is equal to 970. Solving for N of T equals negative 1.354 indicates that this many T-bill, assuming $1,000 par value, must be sold short in the futures market. Because a T-bill contract has $1 million face value, this technique requires selling 1,355 contracts. The same technique used to create bond portfolio 2 can be applied using T-bond future contracts, giving rise to bond portfolio 3. Solving for this equation requires 66,243. So since T-bill future contracts have a face value denomination of 100,000, trader must sell 662 T-bond future contracts for each of the 3 portfolios. Table 624 summarizes the relevant data. Look at the logic here. What are we trying to do? Trying to shorten the portfolio duration, trying to minimize the volatility. The mismatch is if interest rates increase and your liabilities implode on you. Brad Williams, Frugal Finance. Thanks for watching.